Hey everybody, Economic Ninja here. I hope you're doing great. I have got a great story for you today, and it's from a website called A Wealth of Common Sense. Let's see how much sense is common, and actually I don't think there is so much common sense going on these days. Let me know down in the comment section if you agree. This is the title of their story. When will interest rates really start to matter? Because I guess they just don't. Interest rates don't matter. Who cares that your mortgage rates have gone up? Who cares that interest rates on your credit card debt or your auto debt or even student loan debt's gone up? Who cares? Right? Just refi for a longer term. Just do this, do that, rob Peter to pay Paul. Who cares? All right. So this is the website Common Sense. Let's just see how common it is. Here we go. Let's just see what kind of jewels we got here. For the longest time, pundits predicted interest rates would go higher, yet they did nothing but go lower year after year. Okay. I mean, that's true. I mean, that's the crazy thing. I was one of those people say, interest rates are going to go higher, guys. Get ready for that. Interest rates are going to go higher. And they go, well, it hasn't happened yet. Hasn't happened yet. And I go, yeah, I know that, but there's a day where it always goes higher, and then it goes lower, and then it goes higher, and it goes lower. And if you look at a chart of interest rates, it goes, and the highs and lows are only dictated based off of current economic conditions. But there's always a day. The sun will come out tomorrow, interest rates will change. I mean, it's just a fact of nature, right? There's nothing new under the sun. Yet people like this, the really smart people, hey, the pundits say it and they're wrong. All right, so let's dive in a little bit more. You can already see where the ninja's going with this. Then when rates hit 0%, it seemed like everyone assumed we would experience lower rates forever, just in time for rates to rise higher than anyone thought would be possible in a short period of time. Let me tell you what these idiots won't tell you. When they're like, look, interest rates hit zero and everyone expected it to be forever. Let's talk about the last time they hit zero. They actually came so close to zero, it's crazy. 25 basis points. You see, after the Great Recession, it was so bad. Let's still wait. Why even start there? Let's go back to the dot-com bubble burst. When the dot-com bubble burst and stocks were selling off, wealth effect had dropped, the Federal Reserve started diving interest rates. The Fed funds rate, low, right? Then after a period of time of stimulation in the economy, houses started to rise. We blew up that bubble. Stocks started to rise again. They started to bring rates up. That popped the bubble. Then they dove them down during the Great Recession to 25 basis points, a quarter of 1%. Now, how long did that last, Ninja? Well, it lasted about 5 years, because really, if you look at the time we had 25 basis points, the time they started raising in 2015, we sat pretty low around that 25 basis points, give or take a few, plus or minus, during that time. And then we started to raise rates. Now these idiots, these jackamos, are only talking about the time from the last bubble burst, from 2018. That's actually when the bubble burst. Donald Trump came out and said the Federal Reserve's trying to crash the economy. You guys need to pay attention to what's going on. And all he was trying to point you out to was that they were raising rates, and they were raising them in a fashion that would have popped the bubble. Dow Jones fell 19.5% in a period of 90 days. They immediately reversed course, because for one of the first times since John F. Kennedy, they had a president that was calling them out on their crap. And then we started to blow up this next bubble. And COVID started, because they needed that, because the banking system was collapsing. It was a planned event. And these cycles happen every 7 years. It's absolutely mind-blowing. So these guys stop calling people pundits. Maybe they are. I don't know. But that's the whole cycle that people don't understand, okay? So it says here, when rates hit zero, it seemed like everyone assumed that we would experience lower rates forever. And I know that is not the case. I've been warning about that, right? So now they really jacked them up. But this is where it gets really interesting. The smartest guys in the block, I think they are. Not so much. So it goes when it comes to the market. When the rates first began going up, it seemed like it was only a matter of time before the Fed would break something and ZERP would be back on in our lives in no time. But a funny thing happened. Rates went up extraordinary amount, and nothing really broke. Not yet anyways. Well, let me ask you this. Do you think that something is broke? I do. I personally believe that there's all kinds of things that are broke. And what blows me away is that when we're talking about a broke economy, we're literally only watching the dumb money push into certain asset classes like real estate. Those are people that are in fear that they're going to miss out, right? The velocity of transactions in both real estate, even stocks really, but real estate non-durable goods, or sorry, disposable items are extremely down right now, right? Prices tick up a little bit, but we're seeing things like right now, everyone's like, cars haven't come down. I'm like, I just bought a car for 25% under wholesale. I kid you not. And I just don't understand where people don't see this. But it's because they're not trying. They're just watching, but velocity has stopped. Nobody's selling cars. Houses aren't selling. It's like, and they're just like all waiting for the shoe to drop, okay? We've seen supply chain breakdowns. We've seen all kinds of issues. It says, here's a look at current US government bond yields. Now, of course, they're going by bonds, right? And they're going, look at the bond yields are up right now. This is great. Well, they're chasing the Fed. I don't know how to explain that any easier. There are all sorts of crazy things going on here when you consider how inverted the yield curve is. The speed of rise in rates and absolute level of yields we haven't seen, at least on the short end of the curve, in decades. Yeah, you guys. I'm talking to the people that wrote this story. It's because the Fed jacked up rates really fast. The bond market's catching up. Or, this is the crazy thing I think's really happening. Bond yields are rising, extraordinary, and the Fed's having to catch up with them. So when is it all going to matter? Now, I've talked about time lag and how long it takes for someone to stop paying their mortgage and for them to actually be evicted or foreclosed on is literally a matter of well over a year, more like 2 years. But not only that, it doesn't even show up in banks' balance sheets for a few quarters when the masses start pulling up, like what happened with commercial mortgage-backed securities. I was the first person to talk about it on the internet. I kid you not, like nobody was talking about it. And I started that 2 Junes ago. No, not 3 Junes ago now, sorry. And it takes a long time. Now the banks are imploding because of the commercial mortgage-backed securities that are sitting on their assets that are just complete crap assets. I mean, they might as well at this point be junk bonds, right? It takes a long time to figure that out. It says here, when do rates begin to matter to the stock market? There was a story in the Wall Street Journal this week about the substantial increase in equity allocations by older investors. It says here, nearly half of Vanguard investors actively, 401k investors, actively manage their money and over the age of 55 held more than 70% of their portfolio in stocks. In 2011, 38% did so. At Fidelity Investments, nearly 4 in 10 investors aged 65 to 69 hold about 2/3 or more of their portfolios in stocks. And it isn't just baby boomers. In taxable brokerage accounts at Vanguard, 1/5 of investors 85 and older have nearly all their money in stocks, up from 16%. Now think about this, 1/5 from 16%. So that's a pretty good increase, right? In 2012. The same is true of almost a quarter of those ages 75 to 84. You wanna know why that is? It's very easy to figure this out. It's because in 2012, there were so many people shocked by what happened during the Great Recession and the subsequent crash in equities from 2007 to 2009, 2010. All right, people were shell shocked. And a lot of people that lost their jobs and lost their homes were having to pull money out of their 401ks or their stock market just to survive. All right, now you come to this point. I mean, this is like so easy to tell people, it's insane. It's like the educated idiots are just turning into bigger idiots because they keep just regurgitating the crap they read. The reason why more people are putting money in the stocks, it's twofold, because they're chasing yield because of higher inflation. But the other reason is because we haven't seen a correction on a scale of like 50% since 2008. So people literally forget it. People are just like, what are you talking about? Stocks don't go down. Like, yeah, they did. The stock markets have literally, the Dow Jones has fallen by 50% twice since the year 2000. No, I don't believe you. You want to get a chart? You can pull out your smartphone, get real smart. I don't have time for that. Okay, you're an idiot. This is my point. Interest rates are affecting everybody right now. I'm going to tell you, and what's even greater is that they're going to raise rates again this month. Remember when they had the reprieve and I said, it's short, they're going to keep raising? Because they've got to get on top of inflation. And then on top of that, they've got to bring some value to the dollar and give countries around the world a reason to hold physical cash and dollar equivalents like bonds, treasuries, things like that. So how do you do that? You give a better rate of interest. So we're headed for one heck of a crash, mostly because the educated idiots are just that, and they're getting worse. It's so easy to see this, it's pathetic. And on top of that, they don't see the truth that the world's going away from the dollar. And every time a country goes, we need less dollars, that means there's more dollars about to force its way onto our beaches, which is going to cause more inflation, which in turn is going to cause the Fed to have to raise rates even higher. Yikes. Hope you got something out of this. Put down in the comments what you think about it. Hope you guys have a great day. The Economic Ninja is out. Where's that stop button?